Now I will explain how to raise money for your startup. Every entrepreneur must know this. See, what is startup funding and why it is so important? See, startup funding is the capital that entrepreneurs raise to develop and grow their business. It is essential for product development, hiring employees, marketing, and scaling operations. What are the different stages of startup funding? Bootstrapping, this is a self-funding, and pre-seed funding, this is a early idea stage, often from friends and family. Then seed funding, this is the first institutional funding, often from angel investors. Then Series A, Series B, Series C funding, these are all venture capital funding for scaling. Then IPO, initial public offering from public investment. What are the most common sources of funding for startups? First one is a personal savings, that is what bootstrapping. Then angel investors, then venture capitalists, then crowdfunding, government grants, government loans, bank loans, corporate partnerships. Then what is the difference between equity and debt financing? Equity financing involves selling ownership, selling shares of the company to investors. Debt financing involves borrowing money, loans, bonds that must be repaid with interest. How do I determine how much funding my startup needs? This is a challenge. See, calculate estimated cost for product development, operations, marketing, salaries, and growth factor in a 12 to 18 month runaway, and potential unexpected expenses. Then what is bootstrapping and when is it a good option? See, bootstrapping is a self-funding. A startup using personal savings or revenue. It is ideal when founders want to full control and avoid giving up equity. Then what is angel investors and how do they differ from venture capitalists? See, angel investors are individuals who invest personal money in early stage startups, whereas venture capitalists are professional firms that invest larger amounts in growth stage startups in exchange for equity. How do these venture capital firms evaluate startups for funding? They assess market potential, scalability, team strength, business model traction, competitive advantage, financial projections. What are the government grants and how can startups apply for them? The answer is government grants provide non-repayable funds to support innovation and business growth. Startups can apply through official government portals and incubator programs. What is crowdfunding and what platforms are available for startups? Crowdfunding allows startups to raise funds from many small investors. There are platforms like Kickstarter for creative projects and then Indiegogo. This is a flexible funding model. Then Seed Invest and CrowdQ. This is equity crowdfunding. See, how do investors determine a startup's valuation? Investors use the methods like comparable company analysis, comparing similar startups, then discounted cash flow DCF, projecting future earnings, then revenue multiples, value based on the sales. Then what are pre-seed, seed, Series A, Series B, Series C, founding rounds. See, pre-seed is an idea valuation. Small investment, that is like from friends, family, incubators. Whereas seed, this is a initial market traction. Early investors, angels and venture capitals. Then Series A, expansion and scaling, venture capital involvement. Series B and Series C, further growth, larger venture capitals and VCs, institutional investors. See, what is the term sheet and why is it important? The term sheet is a non-binding document outlining key investment terms like valuation, equity percentage, investor rights. It sets the foundation for legal agreement. What are the convertible notes? And SAF is, that is simple agreement for future equity. Convertible notes, this is a loan that convert into equity in future. Whereas SAF is simple agreement for future equity. This is an agreement where investors get equity at a future funding round without specifying valuation now. What is dilution and how does it impact founders' ownership? See, dilution occurs when new shares are issued, reducing existing shareholders' percentage of ownership. Founders may lose control if dilution is significant. What legal documents are required to secure startup funding? See, business registration documents, pitch deck and business plan, then investment agreement and a cap table, that is a ownership structure, shareholders agreements. What are the key clauses to watch for an investment agreements? Equity stake, how much ownership investors get. Then board structure and their rights. Then liquidation percentage, this preference. Liquidation preference is who gets paid first if the company is sold. Then voting rights. How can a startup protect its intellectual property before seeking funding? File for patents, trademarks and copyrights. Use non-disclosure agreements, NDAs with the investors. Secure domain names and branding. What are the common regulatory requirements for raising funds? FEMA, RBI, SEBI, KYC and anti-money laundering regulations, AML, tax registrations, financial disclosures. How does due diligence work in startup funding? Investors conduct due diligence to verify financial records, secretarial records, legal compliances, market potential, business operations. Then what are the biggest mistakes the startups make when raising funds? See, asking for too much or too little funding. Another surprise is not researching investors properly. Investors will do due diligence, but startups also should do research on investors. And another thing is weak business model or unrealistic projections or poor financial records. These are the biggest mistakes startups make when raising funds. Then how can a startup increases its chances of getting funded? Build a strong team, show revenue or market traction, have a scalable business model, and have a network with the investors. And then what happens if a startup fails after receiving funding? See, if the startup shut down, then what will happen? Fund received. Investors may lose their money if equity based funding, or if debt funding was taken, then startup is still liable for repayments. Then how can a startup get funding without a revenue model? Yes, if the startup has a strong innovation, a high growth market, and a solid team. See, many tech startups raise funds before generating revenue. How long does it usually take to close these funding rounds? It varies. Suppose if it is a seed round, it takes 3 to 6 months. If it is a Series A, Series B, Series C, as we discussed, it may take around 6 to 12 months. If it is a crowdfunding, it may take 1 to 3 months. Thank you. Hope you are clear. Bye.